Welcome, everyone. I'm Lori Roth, in tonight for Neil Cavuto. The stock surge, well, it's all about another bailout splurge. The leaders of France and Germany saying they are ready to pump more cash into troubled banks. And Belgium nationalizing one of its banks. And that has Wall Street cheering. It's got my first guest jeering. Congressman Ron Paul says forget the Occupy Wall Street protests. Wall Street itself is the one attacking the free market and capitalism by pushing for these bailouts. Congressman, welcome. They like the free money more than the free market.
Well, thank you. I think you're right. It's the same process over and over again these last 3 to 4 years. Everybody gets bailed out. It doesn't solve the problem because the excessive debt is what you have to get rid of, and you can't have growth until the debt is liquidated. Instead, we just keep transferring from one group to another. So if somebody in Europe bails out the banks because they hold Greek debt, it doesn't solve the problem. It just prolongs the agony, and maybe it gives you a day or two euphoria on Wall Street, but I can't see how this is a solution at all.
What is the solution, and why do governments all around the world, Europe today, it was the United States during the height of the financial crisis, it might be the United States again with the U.S. financials, why do they keep defaulting to the bailout?
Well, I think it took about 60, 70, 80 years of economic wrong-headed thinking that taught that you can't allow these defaults to occur because they call that deflation, and that would be very, very dangerous. But politicians and the central banks always want to inflate, and the market always wants to deflate, that is, get rid of the mistakes. They get to get rid of the excessive debt and the malinvestment. So there's a contest going on. Before the 1930s, they deferred to allowing the market to make these corrections, and they were usually severe and swift, and they got over them rather quickly. But now we have followed the pattern of what we did in the 30s and what Japan is in the process of doing. But I think it's a consequence of faulty thinking and this whole idea. See, a Keynesian teaches that if you're having trouble, it's only because the people aren't spending enough money. But can you imagine depending on the consumers spending more money to get us out of this mess when the consumers are in over their head and they might not have a job, they're losing their houses, and they might lose their job next week, and the solution is more spending. This is what the Paul Krugmans want to do. It cannot work.
Speaking of Paul Krugman, a Nobel Prize-winning economist, the Nobel Prize for Economics this time around, interestingly enough, went to two economists whose research showed that people aren't stupid. They understand, Congressman, that stimulus spending ultimately results in increased inflation and further indebted countries. Average, everyday people get this. Why doesn't Wall Street?
You'd wonder, but why not the politicians who are really in charge of the monetary policy and the spending policy? If you can't spend your way out of these problems, you can't inflate your way out of it, and the average person on the street has figured this out, I think the politicians are way behind the curve. And yet I think there's a lot catching up, and I think that's what the demonstrations are about. They're saying that they don't trust what government tells us because they don't even believe the statistics, because the statistics we get are usually fudged. Because when they say there's only a 2% price inflation, most people know it's a lot more than that. And, you know, if you calculated unemployment the old-fashioned way, like they did in the Depression, it's over 20%. And you just can't fool the people like that and say, oh, it's okay, the inflation's not that bad, and just keep spending money, and we'll keep borrowing money, and everything's going to be okay. People have figured this out, that they don't trust the people who are saying those kind of things.
Congressman, we are looking at pictures of the Occupy Wall Street protesters. Is it a fair argument to suggest that Wall Street is at risk of doing more harm to capitalism with this bailout culture than these people protesting capitalism?
Oh, yeah, but it's probably a mixed bag, because some of those individuals that are demonstrating are against profits and companies. And I do a lot of criticism of Wall Street and the banks, but I think if people get rich because they are insider traders with the Federal Reserve System or getting contracts from the government, and then they get bailed out when they get into trouble, no wonder people get upset. But if you have a Steve Jobs that is very wealthy because he produced a good product and the people loved the product and he produced a lot of jobs, I think that's entirely different. So I'd like to help sort that out and not blame capitalism and not corporations. Corporatism, which means corporations benefiting by special privileges, to me that's an entirely different thing.
Congressman Ron Paul, many thanks for your time and your insights tonight. So The stock rally on Wall Street and around the world, in fact, all about bailouts, not an improving global economy. So does that mean it doesn't have legs? Let's ask Fox Business All-Stars, Jonathan Hoenig, Mark Taji, Francis Newton, and Michael Pinto. Michael, joining me in studio this evening. Great to see you.
Great to see you, Laura.
Market
How are
Rally,
you?
I'm doing great. Thrilled to be here. This is quite an honor sitting in for Neil, of course.
Absolutely.
Market Rally, is this just a bailout boost today?
Well, America's completely addicted to these bailouts. I mean, look what's going on in the country over the past few decades. We have bubble after bubble after bubble, and we thought Europe was going to collapse, okay? And copper went down from $3.50 a pound all the way to $3 below, and oil went from $114 to $78 a barrel. But then we hear, Jean-Claude Trichet is going to rev up the printing press and bail out Europe. Aren't we happy? And maybe we have QE3 in the works over here in the United States. So it's just bubble after bubble after bubble, trying to keep the real healing from occurring, which is the deleveraging of the American economy.
Francis, bringing you in now, do you think that we can ultimately successfully, as Michael's suggesting, deleverage the economy instead of going from bailout to bailout to bailout and creating bubbles and further problems down the road, as we've seen really for a decade at least in this cycle?
Well, I think in this cycle, exactly, the bubbles that we already have in place are going to cause another wave of deflation that's going to rival the Great Depression. It's just a matter of, at this point in time, Obama is trying to keep the stimulus high in order to keep the liquidity high so the market doesn't crash before he tries to go for re-election. But we are already in serious trouble, and no, another bubble is not going to fix it. However, if we do cut the spending, as they did in 1937 by 18%, we have to replace that liquidity with something. And if we don't have a private sector, we will not be able to do that, and we are risking having the debt crisis come over here.
But Mark, the disconnect, or the interesting thing, is that corporate balance sheets are very healthy, and the U.S. stock market as a whole is historically cheap.
That's true. And what's the smart money doing? A lot of corporations are in cash. They're not in the market right now. Yet we see enormous volatility in the markets because of short-term trading. Hedge funds, speculators are moving in and out of the markets with borrowed money. But the smart money is staying on the sidelines, and because they know that the worst is not over yet, Lori.
So, Jonathan, then, do you think that market performance is being thwarted or wrongly influenced by these big institutional traders, and that the sentiment isn't a fair reflection of how Wall Street to Main Street, my conversation with a congressman here, really feels about government policy and bailouts?
Well, I mean, Lori, Wall Street is being influenced not by speculators. Speculators have always existed. Wall Street is being influenced by government. In fact, that's what I really hear the Occupy Wall Street protesters protesting about. Now, that hasn't changed, and the bailouts now in Europe are probably the best example of that. Now, listen, I'm happy to see the market up 300 points, and as our panelists pointed out, it's been dramatically oversold. What worries me is exactly what the congressman pointed out, is the threat of inflation. Even as the stock market has gone up, Lori, we've seen interest rates really start to rise dramatically. I think that's the next shoe to drop for this
Which interest rates?
This economy.
Which credit markets are we talking about?
The 30-year note, the 10-year note, the 2-year note. These are instruments that I trade. I'm actually short them.
But they're headed up
as all this inflation starts to take hold.
Jonathan says we have a threat of inflation. We got 3.8% as the government calculates inflation, 3.8% CPI year over year. So we have inflation already. And, people forget that for decade after decade, from the late 70s to 2000, the price of oil was $20 a barrel. Then it went to $147 a barrel. Now it's back to 85, and we should be celebrating. The people and I'm a Wall Streeter. I've been licensed since 1991. The people that are protesting down there have a point. If their point is that the largest banker in the country, the Federal Reserve, is destroying the middle class, they have a legitimate point. Right. Their solutions are probably all bonkers. I mean, they're probably egalitarian socialists, from what I can see.
Lori.
Come on in. Let's hear it.
Lori, what really worries me is the amount of money we've flooded into this economy. At some point, the Fed is going to have to pull this money out, or we're going to have very high inflation in this economy. I don't know when, I don't know how they're going to do that, but this isn't like a hose. You just flood the economy with money, and then you just turn it off, and it goes away.
I mean,
we could have some very high inflation in the future.
It is interesting to me that interest rates have been low since quantitative easing, the second round, and now we've got the twist, and it's really not making a difference.
They've been falling since 1981. Interest rates have been falling.
We have no risk of inflation.
Our addiction to interest rates has become so inculcated in the American economy that you're right. Sooner or later, the supply issuance of treasuries or inflation is going to drive interest rates higher. And that's when the whole economy falls to pieces.
All right.
And that's I think
last word.
Yeah. No, I just said that's the point. What's a better bet, IBM or U.S. bond? Today, more investors are saying IBM.
Everybody's saying invest in where you're going to get some yield. Thank you very much. We'll check back in with our all-star panel here later this hour. For now, though, the president in a pickle. Protect the populist protesters going after the fat cats, or protect the fat cats who are funding his re-election. It is a